Have you ever skipped a stock like Amazon, like Hims and Hers Health, Palantir, SoFi, any kind of a growth company just because it was expensive, just because it was trading at 80 or 100 or 120 times earnings, and you skipped it? It was just overvalued. But then you looked at it a few years later, the stock keeps on going up. The company remains overvalued. It stays at 60, 70, 80 times earnings, but the stock just keeps on going up. And there's two main conclusions on why that's happening. The first conclusion that most value investors come up with, that this is a bubble. It's all hyped up. It's unfair. It's a scam. It's all a bubble. It's the worst bubble since 2001, since .com. We're gonna crash and everyone's gonna lose everything, and it's just all a bunch of hype. This is the most common analogy. The second analogy is maybe if those stocks wanted to crash, they would have crashed already by now. If it was a hyped up story, it would have already ended. So maybe it's not the market. Maybe it's me. Maybe it's the way I'm looking at them. Maybe it's the way I'm valuing them. Maybe I'm missing something. Maybe I'm making a mistake. And this is when a light bulb went off in my head a few years ago when I skipped so many stocks. Any stock above a 20 PE was overvalued for me. And that's why I understand you guys so much. I read The Intelligent Investor. I read Margin of Safety by Seth Klarman. I invested in all kind of value stocks you wouldn't even touch because they were cheap. But then over time, I learned the hard way after missing out on Amazon and so many stocks just because they were expensive that it wasn't the market. It was actually me. It was my mistake, and I corrected this mistake. And that's what I'm going to share with you guys here in the video. And I'm going to get more hate than love. I know that. I know that stuff. But if you do enjoy it, if I did help you out in this video, if I opened your mind a little bit, all I'm asking from you, if you could please press the like button and let me know what you think in the comments, as those kind of videos, they don't get a lot of views. Okay. Now, the biggest mistake that value investors make, traditional value investors, is they value every single company all the same way. So they do a DCF on every single stock. And this is the biggest mistake you could make, because every single stock should be valued differently. You cannot value every stock the same way. There's no magic formula. There's no kind of website that gives you fair value the same way you get it on an oil stock, the same way you get it on a gold company, the same way you get it on a growth company or a dividend stock. Those are all very different investments. And investing isn't so easy. You need to do much more work than looking at a DCF or looking at a high PE ratio and skipping it just because it optically looks overvalued. It's much harder than that. So don't value every single stock the same way. This is the biggest one. But the main mistake value investors make is they value a company that it's in stage 5 of capital returns, where the company is doing buybacks, doing dividends, rewarding shareholders, the same exact way they value a company in stage 2 in hypergrowth, or in stage 3 where the company has just turned profitable. You look at a number 5 capital return, they're very easy to value. They're paying a dividend, they're doing buybacks, shares outstanding going down, very low debt on the balance sheet, and everything looks fine. Low PE ratio, decent kind of growth, and it's beautiful. Low stock-based compensation, very easy to value. It's very, very easy. But in number 2 or number 3, it's much, much harder than that. You look at the stock, they have high stock-based compensation. They have a lot of dilution because the company wasn't making money. They have some debt on the balance sheet. They have a very high PE ratio, 80 or 100 times earnings. So it's much, much harder to value. And the truth is, the main reason why there's such a big difference is because the company in number 5 is returning capital for one reason. And this reason is because the company cannot find a better way to reinvest the capital. The small companies, they reinvest in themselves. They build new products, they invest in marketing, they invest in strengthening their business model, maybe they do acquisitions, other kind of things. Once the company reaches maturity and it can no longer find a better use of this capital, they start returning it to shareholders. This is why companies pay a dividend. This is why companies do buybacks. And this is why those companies, they don't invest in themselves too much, which means most of the profits go to the bottom line, which makes it very easy for you as an investor to value the stock, because most of the profits, they go on the bottom line. So you look at the PE ratio, it's below 20. That means the stock is a buy. If it's above 20 or whatever, then it's overvalued and you just go and buy something else. It's very, very simple. But in number 2 and number 3, It's very different because those companies are actually reinvesting in themselves. They're reinvesting in the growth. They're reinvesting in research and development. They're investing a lot in marketing. So if you look at the PE, the main reason why the PE is high is because the company is not focused on maximizing profits. And they should not be focused on maximizing profits. They should be focused on widening their moat, on building the company, on building the brand, building a reputation like SoFi is doing with SoFi Stadium and all kind of advertisements. Same thing with Hims and Hers Health. This is where they should be spending their money. They should not be doing buybacks. They should not be doing dividends. They should not be focusing on the bottom line. They should be focused on growing the company and strengthening their business model as much as possible. And this is why the companies PE ratio looks high, because the managers want it to look high, and it should look high because most of the gross profits are going back into the business. And that's why a lot of those companies, for example, you look at the past 5 years, you see a lot of share dilution. This is the wrong way to look at it, because if the company turns profitable, you have to imagine how the next 5 years are going to look like. So last 5 years they were dilutive, but the next 5 years they may not be as dilutive as they were. And all those companies that you make fun of, those companies right now, like Pepsi, McDonald's, at an early stage of their business cycle, they were just like those companies that were not doing dividends. They were just like those companies that had a not as if a wide moat. They were just a website. Like people tell me about Hims, it's just a website. Booking.com was and is still a website. The stock has done very well. Amazon at one point was just a website. Those companies right now are building their moat. You're not going to see the moat. So if you skip it because it has no moat, this is another big problem, because you're valuing the stock in stage two, the same way you're valuing a mature company. This is a big mistake, major mistake. And I'm going to use Amazon as an example. Amazon still is and has already looked very expensive. The company right now is trading at 51 times trailing earnings. At some point, Amazon was trading at 170 times, 200 times earnings, around 86 times, 89 times. The stock's mean PE was 69 times earnings. So the stock has always looked expensive. And it has looked expensive for one reason. And this reason is because Amazon has chosen and is still choosing to reinvest most of the profits in themselves to strengthen the moat, to expand growth for the long term, to create shareholder value through reinvesting in the company rather than giving it to shareholders because they're not finding any better place to put the money in. This is a big difference. And you could clearly see it, let's say, for example, in 2015. In 2015, out of the $35 billion in gross profits, $12.5 billion went to research and development. This is a massive chunk of gross profits. So net income was only $596 million. That's why the PE was at 80 times, because the company was reinvesting in themselves. The company could have cut research and development by 10 or 15%. The PE would have went from 100 times to 50 times. So easily, anytime the company wants to. If the company has reached maturity, you would not see so much in research and development. And research and development, they could pull it back, you could say anytime, if they don't want to focus on growth and they want to focus on the bottom line. So if you look at as a PE ratio, even let's say in 2018, they made $93 billion in gross profit. Research and development was $29 billion. So only $10 billion went to the bottom line. Now, if they cut research and development by half, the PE would have went from 50 times to 25 times. Amazon would have looked cheap. But you're not going to have to analyze it at a PE ratio because the company has not yet reached maturity. So you have to kind of think about it. If the company eventually reaches maturity 10 to 15 years from now, and they don't spend as much on research and development, how much could go to the bottom line? And if you work those numbers in this kind of analogy, then you're going to find out that Amazon has chosen to be expensive because it's reinvesting in themselves. And this is the difference between Amazon and a company like Pepsi. Pepsi is not an innovator. It's an amazing company. I love the company. I used to own it, and I own it from time to time. It's an amazing company, but it's a mature company. It's a company in stage 5, in capital return, entering the decline phase over the next 5 to 10 years. It's eventually going to start declining. No company lasts forever. Maybe Pepsi will because it's an amazing company. But this is the stage of the business cycle. So in number 5, the company is no longer innovating. They already have a moat. They already have a product. They can have to raise prices, do what they have to do. They don't need to find the next website, find the next, whatever kind of AI or whatever it is. They don't have to do that stuff. They have an amazing business. They just have to maintain it and raise prices. So they don't spend a lot on research and development. So out of $50 billion in gross profits, research and development is only $813 million, which puts over $9.5 billion in net income. Now imagine Amazon, if they ever reach maturity, and let's say maturity was in 2018, and the $28 billion in R&D was like $1 billion. Net income would have looked like, it's insane. It would have looked something like 38 billion. The P would have looked like 17 or 18 times earnings. But this is the big difference you have to understand is early stage companies, they're reinvesting in themselves. And that's why the P ratio looks higher than expected. And you have to kind of think about the company. If it ever reaches maturity, what kind of numbers they can put up. Okay. Now, the main thing is, the biggest confusion is, okay, but how do you value a growth stock? How do you value a company that's growing? If you cannot value it on a PE ratio, then how do you value the company, especially if the company just turned profitable? And this is the hardest thing about growth stocks because it's not so obvious. So a lot of it is speculation. And most of the things in investing anyway, they're speculation. Like if you do even DCFs are speculative. Anything in investing is speculation. That's just the way it is. But there's two kind of ways to value a growth company. The first one is the price relative to the growth. So price to earnings growth. So if the company is trading at 50 times earnings and they're growing earnings per share 50%, and you did a lot of research on the stock, you believe they will continue growing earnings per share 50% because their net income margin is 1%, and you believe it could go up to 20%. If they can keep growing 50%, then it's only at one time price to earnings growth. This is very, very cheap. And this is how I bought HIMSS initially. It was trading less than half price to earnings growth back in 2023. And that's how I look at it. Now, the second way to do it is to try to estimate the total addressable market. And if the company gets a share of the market, how much they could potentially make. That was the best way to value Tesla back in its early days. If you looked at the potential TAM of electric vehicles, and if Tesla has a 10% market share, then how much money could they make? That's the most simple one. And that's what I did, for example, on HIMSS a few days ago. And I said HIMSS could still 10x from here. And people were surprised. And I told them the telehealth market is expected to reach 460 billion by 2033. And I believe that's possible. If HIMSS only gets a 10% share, and now they have like a 40% market share, if they get 10%, this is $46 billion in revenues. Using a 2 sales multiple, which is low. Most companies trade 5 to 6 times, sometimes 10. But using 2 times sales, this is a $92 billion market cap. The current market cap is only $8.5 billion. So that was one way you could have looked at a lot of the growth stocks and value them. Now, I know a lot of you guys are going to say this is all speculation, and I'm not saying Palantir is undervalued, and I'm not saying a lot of those stocks are undervalued. And yes, maybe it's speculation, but this is why I always say in investing that the easiest thing to do is to value a company. The hardest thing to do is what do you do after? When do you buy? How much do you buy? What is your position sizing? When do you add? When do you decide to cut it off and move on? Do you just marry your stock and dollar cost average down forever and hold the stock to zero? Or how do you structure different things? That's why investing is hard. That's why investing is not easy. And that's why, for example, I don't have any courses. I have my own Patreon, my own Discord, where I share with people what I do in real time. I don't write books. I don't have courses. A lot of people, they have courses. They sound very smart, but they can't make money. Like they don't know when to do certain things, how to do certain things. That's much harder than valuing a stock. And that's what I, try to share in my group. But the way to think about it is, in most stocks, the downside is the same. It's 100% of your capital. So whatever you put in, you could potentially lose 100%. Okay. Now, the beautiful thing about growth stocks is they have so much upside, like insane kind of upside, life-changing kind of upside. So you don't need a lot of money to put in them if you end up being right. So if you end up being right, the stock goes up 10, 20, 30, 40, 50 times. You're going to make a lot of money, even if you only risked a small percentage of your portfolio. But if you're wrong and the stock goes down 50%, you don't lose too much. And this is why position sizing is key with growth companies and how to look at them. And that was just my video for today. I hope you opened your mind a little bit. I hope you learned something. If you want to learn more about that stuff, join my group. I have more videos about how to value growth stocks and other growth stocks I invest in, along with value stocks, along with everything. I do everything because my goal is to make money, not to follow narratives. That's just what I do. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.